Your phone buzzes at 6:47 a.m. The headline reads, "Global tensions escalate overnight." Your stomach drops before your eyes fully open. You open your brokerage app before you even brush your teeth. The portfolio is red. Not catastrophically, but enough to make your chest tight immediately. You tell yourself you're just checking, but checking turns into calculating. Calculating turns into that familiar, nauseating question: should I move everything to cash right now? That moment, that exact psychological crossroads, is where most financially intelligent people make the single most expensive mistake of their entire investing lifetime. I've researched it extensively. Before we go further, I want to ask you something genuinely. Have you ever sold during a crisis and regretted it? Drop your honest answer in the comments below. If you've never subscribed to this channel, do it right now, because what I'm about to show you is the kind of framework your financial advisor probably hasn't walked you through properly. Here is the first thing you must understand. Wars are not portfolio killers. Historically, they are the opposite. The data across 110 years is unambiguous, and almost nobody talks about it. The Dow Jones gained 50% during World War II. The S&P 500 delivered positive one-year returns after 73% of every armed conflict since 1945. Markets don't die in wars. I spent months researching wartime financial data, digging through CFA Institute reports, Federal Reserve archives, and institutional investment records. What I found completely reframed how I think about crisis investing. Wars are, economically speaking, the most aggressive government stimulus programs in human history. When conflict begins, governments spend without limit on weapons, logistics, fuel, and infrastructure immediately. That spending flows directly into publicly traded companies. The government becomes the world's single largest customer overnight, and it pays whatever the invoice says without negotiating price downward. The investors who suffered most in every major conflict weren't the ones who held their positions. They were the ones who sold broad market exposure and waited in cash for safety. Cash feels safe. It feels rational. It feels like you finally took control. But while you're holding it, inflation is quietly eroding every dollar sitting untouched in your account. Wartime inflation averages 4.5% annually versus 3% during peacetime. That gap doesn't sound dramatic until you realize it compounds across months while you're waiting for the news to feel better. And the news never feels better at the right moment. The financial media has no business incentive to calm you down. Your anxiety is genuinely their most profitable product. Every time geopolitical tension spikes, viewership climbs, ad revenue climbs, and engagement metrics go vertical. The more frightened you are, the longer you stay watching, and the more they earn. When markets fall 2% on a war headline and the chyron reads "Global Markets in Freefall," understand what that language actually is. It's a business decision, not a financial assessment. A 2% drop is a routine Tuesday in any normal market cycle. It gets called freefall because freefall makes you click, share, and stay. Moderate pullback does not generate the same revenue. JP Morgan tracked this with precise data. A $10,000 investment held in the S&P 500 from 2005 through 2024 grew to $71,000 if left completely untouched through every crisis. Miss only the 10 best trading days across roughly 5,000 trading sessions, and you end with $32,000 instead. Miss 30 best days, and you're essentially at break-even after 2 full decades. 7 of the 10 best trading days in any given period occur within 2 weeks of the 10 worst. The crash and the recovery are practically the same single financial event. The media covers the crash breathlessly for weeks. The recovery gets a brief segment between commercials, because recovery as a media business model generates almost no sustained viewer anxiety whatsoever. Now I want to introduce you to 2 people. Call them David and Claire. Same portfolio size, same morning, same news alerts, same access to identical financial information on that day. David watches 3 hours of crisis coverage, sees the word catastrophic approximately 40 times, and sells his entire index fund position by 9 a.m., feeling briefly, powerfully in control. Claire reads one data point. The S&P 500 has recovered from every major armed conflict since World War II. She closes the app, finishes her coffee, and goes to work completely unbothered. Everything that follows is the story of what Claire did next in the exact order she did it, and why the gap between her and David will genuinely disturb you. But before the investment framework, there is something more important to address. You can know every strategy in this video and still make the catastrophically wrong decision under real pressure. Panic selling doesn't feel like panic from the inside. It feels like clarity. The market is falling, the news is terrible, and selling feels like the only rational, intelligent response available. You hit the button. You feel immediate relief. You've done something. You're no longer watching a number fall helplessly. That relief is the most financially dangerous emotion a person can experience. Because the market recovers. Maybe it worsens first. Maybe it takes 3 weeks, but it recovers. Because across 110 years of wars, recessions, and pandemics, it always has recovered, completely. And you're on the sidelines in cash, losing purchasing power daily, waiting for the moment it finally feels safe enough to re-enter. Your brain always answers that question the same way: not yet. By the time clarity arrives, the snapback has already happened without you. You locked in the loss permanently and missed the recovery entirely. That is the complete anatomy of a wealth-destroying decision. Now, here is exactly what Claire did, built in the precise order that actually matters when the world feels like it is genuinely coming apart at every seam simultaneously. Step 1. Before a single dollar moves anywhere, Claire confirmed she had 6 to 12 months of living expenses in a high-yield savings account and a government money market fund immediately accessible. She also kept $2,000 to $5,000 in physical cash at home. Not dramatic, not paranoid, a straightforward hedge against a short-term digital banking disruption caused by cyber warfare infrastructure attacks. When Russia was cut from SWIFT in 2022, Russian citizens faced non-functional ATMs overnight, not because their money disappeared, but because the digital infrastructure moving it was simply switched off remotely. Cyber attacks on payment systems are the documented first-strike tool in every major modern conflict. Physical cash covering 2 to 3 weeks of expenses is basic financial resilience, not extreme prepping behavior. But this is also where Claire stopped with cash completely. Buffett said it directly: holding excess cash during wartime is one of the worst possible things you can do with money. Step 2. Gold. 10 to 15% of investable assets. But not for the reason most people instinctively think when they hear the word gold during a geopolitical crisis situation. The instinct is, buy gold because the world is ending. That instinct is right about the asset and completely wrong about the timing if you're buying after headlines are already screaming crisis. People who bought gold at its January 1980 peak during the Soviet invasion of Afghanistan waited 26 years to break even in inflation-adjusted terms. Timing the fear spike destroys the gold trade entirely. Gold works best when bought before it's on every front page. Right now, central banks have been purchasing over 1,000 tons annually since 2022, the highest institutional buying levels ever recorded globally. That is not panic buying. That is sovereign wealth repositioning away from dollar dependency. When the people managing national treasuries are quietly accumulating, the structural move has not finished yet at all. The practical vehicle is IAU or SGOL, both holding physical gold at near zero cost. Claire already owned it before February 2022 and watched it climb while David's cash sat completely motionless. Step 3. Defense, 10 to 15%. This is the trade wartime history hands investors every single cycle, and most people don't take it because it creates genuine personal discomfort psychologically. Raytheon gained 37% in the single week following September 11th. A $10,000 investment split across the top 5 defense contractors in September 2001 was worth $97,000 by August 2021. That is documented. Lockheed Martin has returned over 1,200% since the War on Terror began. In 2022, while the S&P lost 18%, defense stocks outperformed the broad market by 28 full percentage points simultaneously. The cleanest vehicle is XAR, equal weighted exposure, so you're not concentrating everything into 2 dominant companies. It has returned over 20% annually for the past decade, with genuine structural demand behind it. Step 4. Energy, 10 to 15%. Every major conflict restricts supply, panic drives premiums, and energy companies print cash. In 2022, XLE gained 64%, while the S&P lost 18% simultaneously. Step 5. Consumer staples, 10 to 15%. People don't stop buying Tylenol during a war. XLP lost only 4% when the S&P dropped 17% through August 2022, with a 2.5% dividend. Step 6. Inflation protection, 5 to 10%. Standard treasuries lost 67% of real value during World War II. Use TIPS or Series I bonds instead. Never touch TLT during wartime inflation. And your index funds, your VTI, your VOO, your SPY, are completely untouchable. CFA Institute data shows large-cap stocks returned 11.4% annually during wartime, higher than the 10% peacetime average historically recorded. David's $40,000, 4 years later, is worth roughly $48,000. Claire's same starting amount, with automatic contributions maintained and tactical positions added, grew to approximately $91,000. Same news, same morning, $43,000 difference. She didn't find a magical stock. She built a structure before the crisis, held it through the noise, and kept buying quality assets at a discount every single month without hesitation. So when your phone explodes with red headlines and some analyst explains why this time is categorically different, the person without a structure panics. The person with one makes coffee and waits calmly. If this video reframed how you think about crisis investing, here is what I want you to do. Like this video because it tells the algorithm this information actually deserves a wider audience reach. Subscribe because the next crisis will not announce itself politely in advance, and when it arrives, you will want this framework already loaded and ready, not something you're scrambling to find afterward. And drop one word in the comments describing how you currently feel about your portfolio's crisis readiness. Just one word. I read every single one, and your answer might shape the next video entirely.